Well, hopes of a March rate cut are dwindling as Fed officials brace investors for the possibility of a higher for longer rate environment. So just this week, we've heard from Fed Presidents Neil Kashkari, also Austin Goolsbee, echoing the cautious sentiment that came out from Powell last week and over the weekend on his interview for 60 Minutes. Now, one sector that will be and has been heavily impacted by rising rates or the higher rates for longer is housing. Mortgage rates climbing along with the Fed funds rate until they tipped over 7%. Now they're steadily returning to earth just a bit, though, but lots of questions about where we go from here. So let's talk about it. We have Andrew Carter. He's a director at Stifel. Andrew, it's good to see you here. So we've heard it from a number of Fed officials. We heard it from Powell himself that it's very unlikely we're going to get a rate cut here in March. What does that mean then for housing?
Yeah, I guess for housing is, and one of the issues with housing is it's driven by or home improvement. Let me be clear. Therefore, housing, kind of where the implications are, is you need housing turnover. That's probably going to still be anemic, even with some rate relief. We've been in the camp that existing home sales would be kind of lethargic. That's going to temper the amplitude of the recovery, and then also the separate side of it is projects that are financed. 29% of projects over $30,000 are financed in some forms. So those two things are going to hit home improvement. Back to your question around housing, it's going to probably really lead to continue to throttle existing home sales.
And so as we're looking across the entire sector here, what does that spell out then for some of the new home sales where building is still taking place, but we're even seeing some of that speccing activity start to moderate a little bit?
Yeah, I would say the good news for new home sales is we've got a good wide range of estimates out there on what the shortage in this country is. Our KBW colleagues say it's about 1.5 million. Some of my think tank colleagues here say it's 2.7 million. Either way, you've got a nice deficit you're cutting into. We've seen some nice momentum there on permits, mortgage applications. I think we're up 22% for new homes. So at least that end market's going to kind of continue to do well and cut into kind of that supply glut. It's most relevant for Site One Landscape, which we cover 21% of revenue related to new construction. But the reality is it's going to take time. And what that leads to is we've got really a near all-time low vacancy rate, 0.99%. And therefore, you're just going to have the affordability problem is going to remain one just because of a dearth of supply. With new homes, I think probably a good end market, but not enough to really move the needle on that core problem of affordability.
So, Andrew, let's talk about what this means here for some sector-specific names. And I know you're tracking pool companies. A number of them are set to report. When you take a look at pool permits, what that activity looks like, how does that position so many of these companies that are very reliant on either people moving or upgrading their homes?
Yeah, I mean, the one that's across our coverage that's most tied to existing home sales is Floor & Decor. We calculated that existing home sales has explained about 52% of the variance of their comparable store sales over the last 6 years. So that's the biggest one, and our outlook doesn't really say a return to growth in the second half of the year. You mentioned the pool categories, some different dynamics going on. That is a higher income. We found that is typically a higher income consumer. So the high end has been extremely resilient. Mentioned our pool permit analysis where we track about 50% of new construction in the U.S. It's the $100,000 pools are growing. It's declines in the others. So the pool category, we actually think that one can be flat next year. Kind of flies in the face of kind of the high ticket durables, but it had a pretty severe correction last year in 2023, underperforming that, of course, over the next couple of weeks. We've got Pool Corp's going to report in a couple of weeks. We've got 3% revenue growth there. That's more the value ad side. Then we've also got Hayward reporting on the 29th.
This may start to take us a little bit outside of your coverage, but it certainly is annexed to this entire industry and conversation. What does it spell out for some of the appliance companies that are at the center of that Venn diagram of both home projects where you're perhaps revamping a part of the home, plus some of the new home side where you're taking on new appliances to put into those homes as well?
Yeah, sure. Good question. I mean, that's actually pretty relevant for us. That's 9% of Home Depot sales and 14% of Lowe's sales. And Lowe's is the appliance leader in the U.S. I know one thing that Lowe's is kind of in this kind of correction here where kind of the new sales, typically those don't really go through the home centers. It's the other one that's a high ticket durable. It does go to existing home sales. They've seen pressure in that category all year. They've seen a higher return to promotional levels in the quarter. That's kind of one of the factors that is contributing to kind of underperformance that happened in fiscal 3Q for Lowe's versus Depot and what's in our estimates right there. But right now, I think it's just going to be a category where it's tough sledding, and you're hoping that the depth of kind of deflation kind of moderates a little bit. But to your point, the existing home sales part, the high ticket part, we're also lapping a couple of years of kind of excess buying. We're not in that more, so we're really watching the promotion in that category as it relates to Depot and Lowe's.
All right, Andrew Carter, Stifel Director, thanks so much for joining us here this morning to break that down for us.